All right, let's get right into it. For millions of people, a federal tax refund is a huge deal, a major financial event for the year. But deep inside the U.S. Treasury, that refund is seen as something totally different. It's a target. Today, we're going to do a full forensic review of the system that intercepts those refunds. We're talking about the tax refund offset. We're going to dissect the law, the mechanism, and, crucially, the remedy for folks who get caught in the crossfire. Okay, let's dive in. This quote right here really frames the whole issue perfectly. A tax refund offset isn't just some little accounting trick. It's the end result of this massive legal framework that basically turns the IRS into a collection agency for all sorts of government debts. It all happens at this really complex intersection of tax law, government procedure, and even state property laws. So to really get to the bottom of this, we're going to break it down into 5 key parts. We'll start with the legal authority that makes it all happen, IRC Section 6402. Then we'll look at the actual machinery, the Treasury offset program. After that, we'll get into the main conflict, the joint return problem. And finally, we'll pull apart the solution, Form 8379, and the very specific formula the IRS uses to figure it all out. Okay, so first things first, where does the government even get the power to do this? Well, it all starts right here, with Internal Revenue Code, Section 6402. This is the absolute bedrock of the entire system. It's the law that gives the federal government the authority to grab a refund before it ever even hits a taxpayer's bank account. Now, this is where it gets really interesting when you look closely at the language of the law itself. Subsection 6402A uses the word may. This gives the IRS some wiggle room, some discretion when it's collecting its own tax debts. This is actually the legal basis for something called an offset bypass refund, where the IRS can choose not to take a refund if it would cause a major economic hardship. But then look at subsections C and D. The language changes completely. It uses the word shall. That's a command. So once a state agency says, hey, there's past due child support here, or another federal agency flags a debt like a student loan, the IRS has no choice. The offset becomes mandatory. Their hands are tied. So we've got the legal authority down, but how does this actually work in the real world? Well, that brings us to the engine that drives this whole process, the Treasury Offset Program, usually just called TOP. The whole thing runs like a well-oiled automated machine. It kicks off when a creditor agency, like say the Department of Education, tells the Treasury's Bureau of the Fiscal Service, or BFS, that a person has a past due, legally enforceable debt. The BFS then puts a tag on that person's taxpayer ID number in this giant database, the Debtor Master File. Then when the IRS processes that person's tax return and says, yep, a refund is due, the BFS system immediately finds the match. It snatches the refund, pays the agency that's owed money, and only then does the taxpayer get a letter saying what just happened. So what happens if you owe a few different kinds of debt? Well, the law has a very strict pecking order, what you could call a waterfall. The Code of Federal Regulations lays it all out. First in line, the IRS gets its money for any back taxes. Second, past due child support. Third, any other federal agency debts. And only if there's anything left over after all that does the money go to state income tax or unemployment debts. This order isn't a suggestion. It's the law. Okay, this brings us to the real heart of the issue, the central conflict we're digging into. The system we've just described works pretty cleanly for a single person. But what happens when a married couple files their taxes together and only one of them owes the debt? This is what we call the joint return problem. The problem really comes down to this legal concept called joint and several liability. What that means is, for tax purposes, when you file a joint return, the IRS sees the couple and their refund as one single thing. It's indivisible. And because of that, the entire joint refund can be taken to pay for the separate, pre-existing debts of just one spouse. The Treasury Offset Program doesn't see a his and hers, it just sees one big pot of money that it's allowed to take from.
Now, before we go any further, we have to make a super important distinction here. People get this wrong all the time, and even the IRS manual warns about it. An injured spouse claim is not the same as an innocent spouse claim. An injured spouse files Form 8379 because their share of a refund got snatched for their spouse's separate debt. It's all about getting your piece of the overpayment back. An innocent spouse, on the other hand, files Form 8857 to get relief from the tax debt itself, usually because their spouse messed up the return or committed fraud. 2 totally different forms for 2 totally different problems.
So, for that non-debtor spouse who had their part of the refund taken, what's the solution? The remedy is Form 8379. You can think of this form as a specialized forensic tool. It's designed specifically to dismantle that single joint refund and prove to the IRS exactly what portion of it really belongs to the injured spouse.
Now, there's some really strict rules for filing this. It's only for married filing joint returns, obviously. You can send it in with your original tax return, and you should write injured spouse in the top left corner, or you can file it by itself after the offset has already happened. And this is critical. If you file it separately, you absolutely have to attach copies of all the income documents, like W-2s and 1099s, for both spouses. And don't wait around because the clock is ticking. You're bound by the same statute of limitations as any other refund claim under IRC Section 6511.
And yeah, this is not a quick fix. You're going to need some patience. The IRS says right in its own instructions that it can take up to 14 weeks to process a paper-filed claim. It's a little faster if you file it electronically with your return, about 11 weeks. But either way, you're going to be waiting for a while.
Okay, let's roll up our sleeves, because we're at the technical heart of this whole thing. How does the IRS actually calculate the injured spouse's share? It's not a guess. It's not an estimate. It's a very precise formula that's been on the books for decades. So let's take a forensic look at how this allocation is done.
And here it is. This is the separate tax formula, which goes all the way back to a 1980 revenue ruling. What the IRS does is basically create two hypothetical married filing separately returns to figure out what each spouse's individual tax bill would have been. Now, step D is where the magic happens. They calculate the injured spouse's share of the actual joint tax by taking their separate tax, dividing it by the couple's total separate tax, and then multiplying that ratio by the tax from the real joint return. That tells them exactly what percentage of the total tax bill belongs to the injured spouse.
So once the tax liability is split up, the IRS does the same thing for all the payments and credits to see who paid what. And again, it's super specific. Federal income tax withholding, that's easy. It's traced directly to the Social Security number on your W-2, non-negotiable. Estimated tax payments? Those often get split up using that same tax formula we just looked at. And refundable credits, like the Earned Income Tax Credit, they generally go to the spouse who earned them. And of course, just to make things more interesting, this can all get way more complicated if you live in a community property state where a whole different set of rules applies.
And just to give you a sense of how insanely precise this process is, check this out. The Internal Revenue Manual, specifically Section 21.4.6.5.6, says that the IRS has to carry out the entire allocation calculation to 4 decimal places. 4. They only round to 2 decimal places at the very end when they figure out the final amount. This is not guesswork. It's a highly detailed forensic accounting process. So after all that incredibly detailed math, there's one final rule you have to know. The amount that gets refunded to the injured spouse can never be more than the total overpayment that was on the original joint return. Plain and simple, you can't get more money back than was overpaid in the first place, no matter what the allocation math says your individual contribution was.
And that really brings us to our final thought. We've seen just how powerful IRC 6402 is and how automated the Treasury offset program has become. And we've also seen the incredibly detailed, almost surgical process for filing a Form 8379 claim. It really raises a fundamental question, doesn't it? As the government's collection tools get more and more powerful, more efficient, is this complex, multi-week process a good enough protection for a spouse who didn't owe any debt to begin with? It's a question about balancing efficiency against individual rights, and it sits right at the very heart of this entire system. Thanks for joining this deep dive.